If you've inherited a property, I'm sure you've been wondering if there are ways to avoid or reduce capital gains tax. In this video, I'll go over 7 strategies you may want to consider that may help you offset or minimize capital gains tax on a property you've inherited. Let me start with a disclaimer. I'm a real estate professional and I'm sharing with you tactics some of my clients have used and tips I've learned as a certified probate and trust specialist. I'm not intending to give any legal or tax advice, so it's essential you consult with your accountant, financial planner, or estate attorney before making any legal or financial decisions in an attempt to decrease the amount you pay in capital gains. That's my disclaimer and I'm sticking to it. Now let's get started with the fun stuff. What is capital gains tax? It's a tax on any profit made from the sale of assets like real estate, stocks and bonds, or even a car. My focus is real estate, so I'll be talking about the sale of a property. Here in California, you'll not only have a federal capital gains tax, but rest assured, the sale of real estate can be subject to a state tax too. How can you minimize capital gains tax on a property you've inherited? Number 1, sell the property quickly. When you inherit a property, there's an adjustment called a step-up basis. The cost basis of the property is stepped up to its current market value at the time of the trustor's death. If the property qualifies for the stepped-up basis and you sell the property soon after you inherit it, then you would only pay capital gains tax on the increase in value from that new stepped-up basis. If you sell shortly after inheriting, your tax liability may be minimal. For example, Harry's dad bought a home in the 1970s for $180,000. When he passed away, that home was worth $850,000. With the step-up basis in place, and if Harry sold the home, let's say a year later for $900,000, he would owe capital gains tax on the $50,000 in capital gain. Number 2, hold and use the inherited property as your primary residence. If you move into the inherited property and make it your primary residence, you can potentially qualify for the home sale exclusion. Most of the time, you'd need to live in the property for at least 2 out of the last 5 years before the sale of the property. And then this allows you as an individual to exclude up to $250,000 of capital gains when you sell the home, or $500,000 as a married couple. Number 3, rent the inherited property. Renting out the property can generate income for you and potentially offset the capital gains tax liability. You can also claim depreciation deductions against rental income, which rolls us right into number 4, which is a 1031 exchange. If you use the inherited property as a rental and you decide to sell it at a later time, you may be able to defer capital gains through something called a 1031 exchange by reinvesting the proceeds from the sale of the inherited property into another like-kind investment property. By reinvesting the proceeds from the sale of the inherited property, you may be able to defer the capital gains tax. Number 5, gift the inherited property. Instead of selling the property, you may be able to gift it to the next eligible family member or to donate it to a charitable organization. Keep in mind that there may still be gift tax implications, but it could be a way to transfer the property without incurring immediate capital gains tax, or it could potentially allow you to claim a charitable deduction on your income taxes, offsetting some of the capital gains tax liability. When Jim and I were running a nonprofit, our organization received a property as a donation, and it was such an amazing gift, and it allowed us to be able to impact so many others in our community. It really was incredible. Number 6, installment sale or seller financing. You could sell the inherited property using an installment sale, which spreads out the tax liability over several years, reducing the immediate tax impact. In this case, instead of the buyer paying for the property all at once, the buyer would make an agreed upon series of payments to you. As an example, Charlie has a property that he inherited several years ago that is now worth $550,000. When Charlie inherited the property, his step-up basis was less than $100,000. Charlie is looking at over $450,000 in capital gain. Rather than have a buyer get a loan to purchase the property where Charlie would receive the full $550,000 at the close of escrow, Charlie offers to sell the property with seller financing or an installment sale. Charlie and the buyer enter into an agreement where the buyer pays Charlie directly, spreading out Charlie's income from the sale over time. This is actually what Jib and I did for the home that we're living in now, and it's working out pretty well for us and for the seller who inherited the property. And number 7, deduct your selling expenses. To minimize capital gains on inherited property, it's a good idea to consider deducting any and all expenses associated with home improvements or the selling process. And this will include title and escrow fees, real estate commissions, and any renovations, repairs, or maintenance done to the property. If you're thinking about using this strategy, it's crucial to keep meticulous records of all home improvements made since acquiring the property and hold on to all receipts. Remember that tax laws are always subject to change, and the best strategy for you will depend on your financial situation and your goals. It's essential to work with a tax advisor or financial planner who can provide a tailored guidance based on the most current tax laws and your specific circumstances. Hey, thanks for watching, and if you found this of value, please like, comment, subscribe, and hit the bell button. I hope you did find it of value and that you can watch this video here so that you can become better educated and know what to expect when inheriting a property. Thank you for watching, and I'll see you next week.